friends, today we will start with the banking system in India. Friends, in last video of supply of money, we studied the money creation by commercial banks. Now here we will study how commercial banks create money. Friends, commercial banks are the suppliers of the money in the economy. They have no authority like central bank to issue currency, but still they are the suppliers of money. How so? Friends, they create money via demand deposits. So friends, here we will study how exactly the commercial banks create money. Friends, let us assume that all banks in the economy receives cash deposit of rupees 10,000. Now here this 10,000 as a deposits are the liability of banks. But as a cash reserves, they are the assets of the bank. Guided by the historical experience, all depositors never withdraw their deposits at a single time. Therefore, banks find it safe to keep a part of their deposits as a reserves and lend, say, loans to the borrowers. So friends, banks keep 10% of their demand deposits as a cash reserves. Here 10% of 10,000 is rupees 1,000. So friends, 10% of 10,000, that is rupees 1,000, is the cash reserve that commercial banks will keep with them. And the excess reserves with bank, that is rupees 10,000 minus rupees 1,000, that is rupees 9,000. Now banks can safely lend rupees 9,000 as a loan and can earn interest income on it. Friends, point to be noted is banks never offer loan in cash. Instead of that, account is opened in the name of the borrower and amount is reflected as a credit in his account. Friends, now banks have increased their liability by rupees 10,000 plus rupees 9,000, that is rupees 19,000. Both are demand deposits because money can be withdrawn or transferred via checks. Friends, now here rupees 10,000 are called primary deposits and rupees 9,000 is called secondary deposit that can be credited as a loan. Now, as a demand deposits, banks have rupees 19,000 and required cash reserves are 10%. 10% of 19,000, that is rupees 1,900. Still they have the excess reserves. Excess reserves is equal to actual reserves minus required reserves. That is rupees 10,000 minus 1,900. That is rupees 8,100. In fact, banks still have excess reserves to create demand deposits. So by loaning, banks only increase their financial liability in terms of demand deposits and cash reserves of the bank continue to remain as of rupees 10,000. As such, the process of creating demand deposits continues till the excess reserves are not fully exhausted. Hence, money supplied by banks is called credit created by banks, or we can say this is the money created by banks. Cash held by the commercial banks, that is rupees 10,000, is never treated as a component of money supply because as per law, stock held by the money creator is not a part of money supply as we have studied in the earlier chapter of money supply. So friends, here comes the formula for money creation. Demand deposits of commercial banks is equal to 1 over RR, that is required reserves into cash reserves. Friends, RR is a reserve requirement taken as the percentage of demand deposits of commercial banks. That is 1 over 10% into 10,000 is 1 lakh rupees. Friends, notice here K is considered as the credit multiplier. Friends, look here, K is equal to 1 over RR. That is Money multiplier, that is K, is reciprocal of reserve requirements. That is 1 over 10% is exactly equal to 10. So 10,000 multiplied with 10 gives us rupees 1 lakh. I think concept is very clear with you and you are very clear with the formula for money creation. Now here comes reserve requirement of commercial banks. Friends, RR is popularly known as CRR, that is cash reserve ratio. In Canada and UK, commercial banks themselves can decide RR, but in India and USA, it is decided by RBI in India and Federal Bank in US. Friends, CRR is exactly a percentage of total demand deposits kept by the commercial banks with RBI. Friends, in India, actually it is 4% of demand deposits of banks, which we have earlier assumed to be 10% of demand deposits in our formula done earlier. Besides CRR kept with RBI, banks keep excess reserves with themselves called wallet cash. That is a operative cash, whereas CRR is non-operative cash reserves. SLR, that is statutory liquidity ratio. Friends, students are generally confused with these terms. SLR refers to those liquid assets, that is cash, gold and unencumbered securities. These are those securities against which commercial banks have issued no loans. Friends, SLR in India is determined by RBI. It is one of the instruments of monetary policy of RBI. Friends, RBI increases SLR to increase liquid funds with commercial banks and it reduces the deposits with RBI for the purpose of credit creation. That is, it reduces credit or money supply by commercial banks and vice versa of it. If RBI reduces SLR, it will reduce liquid funds with commercial banks and that will increase deposits with RBI for the purpose of credit creation. Then commercial banks could increase credit and money supply by the commercial banks will be increased. So this is how SLR works in the economy. And let me clear one more very important point with you is friends, secondary deposits are also called derivative deposits. So friends, that is all for today. In next video, we will continue with how Central Bank of India, that is RBI, controls the supply of money. Till then, bye-bye. Friends, if you really like the video, do subscribe it. Thank you.